This is the Alt Thinking Podcast by 9 Point Partners. Today, featuring the DeFi Decoded series in partnership with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, everybody, and welcome to today's episode of DeFi Decoded. I'm Alex Tapscott here with my co-host, Andrew Young. This is episode 5, I believe, and we're going to be diving into a very interesting subject, the derivatives market in the DeFi space. So derivatives are one of those aspects of financial services that I think a lot of people don't really understand all that well. They were originally designed as a way to sort of mitigate risk. You know, the first derivatives really were, futures contracts. Basically, I'm a farmer, I grow some corn, I want to guarantee a certain price at a future date, so I don't have to worry about a fluctuation in between. So I'm going to, enter into a contract to sell it at that price. That's actually a derivative. So very simple kind of concept, but it spawned a much larger ecosystem where today most derivatives trading is not done for managing risk, but is done for profit seeking, basically trading or speculation. And so that's what we're going to focus on today's episode. We are going to talk about DeFi and insurance on a later episode, which will obviously touch on derivatives. But today we're focusing on trading. So Andrew, tell us about DeFi derivatives.
Yeah, thanks, Alex, and happy to be here again. So derivatives are the single largest asset class in the world with an estimated notional value of over a quadrillion dollars by some estimates. However, decentralized derivative platforms haven't really taken off in DeFi quite yet. And we'll talk a little bit about that. But these decentralized derivative platforms essentially enable users to create their own derivatives and then transact them with others in a completely permissionless and decentralized fashion. In today's episode, both of us are going to dig into this decentralized derivative space and discuss why these derivative platforms have yet to experience the rapid growth that many are projecting and that's being seen in the other areas of DeFi, like lending. We'll also compare decentralized crypto derivative platforms like dYdX and Perpetual Protocol to their more established centralized peers like BitMex and FTX.
Right. And BitMex and FTX, of course, are centralized peers in the crypto space. And then, of course, there's a world of the derivatives market, both that goes through exchanges, but also over the counter that exists between banks and other traditional financial institutions. So we're looking at a pretty narrow little subset here, but like all things in DeFi, right, it's not the size of the market today, even though the markets may be quite large. In the case of lending, right, 11 billion, it's all about the growth and, extrapolating from the growth where we think all of this is going. So Andrew, we're talking about a subject that is not well understood, which is derivatives. And then within that, we're looking at it on a DeFi level, right? So we want to make sure we don't move too quickly, lose anybody on this. So let's just talk about really simply what is an example of a derivative in the DeFi ecosystem, and how does someone enter into one of those kinds of agreements?
Yeah, it's a good question. The main type of derivative that dominates the DeFi space is this idea of perpetual futures. So perpetual futures are actually an entirely new type of asset that don't actually exist in the traditional financial ecosystem. And they were invented by and sort of pioneered by BitMex around 5 years ago. So BitMex is sort of the centralized crypto derivative platform. And what's interesting about perpetuals is, unlike typical futures, perps or perpetuals never expire. So they remain effective until the trader closes their position. There's no set expiry date or settlement date like there is in the traditional futures contracts. And perps essentially allow traders to speculate on the future price of a given asset, either by going long or selling, or going short, I should say.
Right.
The perps. And as of today, there's kind of two main types of perpetual platforms. There is the peer-to-peer systems, which have sort of a traditional order book. And the main platform there is dYdX, based in San Francisco. And then there's the peer-to-contract systems. So that's what Perpetual, the project's actually called Perpetual, Future Swap, and Synthetics. And we'll talk a little bit about the differences between those because they're very much different.
Yeah, well, let's talk about a perpetual future, sort of an odd concept, right? Because normally you think of a future as having a specific future date at which the one of the parties needs to deliver the underlying asset, right? And then after that, it sort of expires, sort of like an option contract. So we're talking about something that's perpetual. So it sounds like it's really only exclusively used for trading and speculating. Is that basically correct?
Yeah. So there you can do the main actual. Funny enough, the main, I guess, use of perpetuals initially started off for Bitcoin miners.
Right.
So kind of similar to your farmer example. Instead of trying to lock in a future price of grain, Bitcoin miners were trying to lock in a future price of Bitcoin, just to give themselves more certainty and allow them to raise capital easier and stuff like that.
Yeah. Well, that's an example of it being used as a risk mitigation, tool, right?
Exactly.
To ensure against future uncertainty, at least.
Yeah, and then exactly and what happened, similar to the traditional futures market, is that the speculative usage of these perpetuals has at this point far exceeded sort of the fundamental use in terms of risk management. And a lot of that was due to sort of the crazy leverage that you could take out on these perpetuals. So in contrast to sort of the traditional futures market, in the perpetual futures market of crypto, it's not uncommon to be able to take out up to 100 to 1 leverage. So you could have.
I mean, that's insane.
You could have $1,000 and put on $100,000 long on Bitcoin.
But then if Bitcoin tick has a 1% tick, aren't you wiped out?
Exactly, you get liquidated, or
right.
The terminology for crypto is wrecked.
Right.
Yeah. And that's actually coming down. So for example, FTX, which is the main, actually just announced that they're lowering their maximum leverage to 20 to 1.
Yeah.
And they actually said that the average leverage ratio taken out at FTX was lower than 5 to 1. Not that many people were using the crazy 100 to 1 leverage, just because it's sort of unfeasible, given the volatility of crypto. But with that being said, 20 to 1 is still pretty crazy. And
reminds me of that I don't know if you remember that Chris Rock bit where he's like, just because you can do something doesn't make it a good idea. He's like, you can drive a bus with your feet if you want to, but it doesn't make it a good idea. It's like you can get 100x leverage, but that doesn't make it a good idea. And I think a lot of people, that's a bit of a self-regulation on the market. Like people, even degenerates who love to gamble, maybe 3 or 4x is enough leverage for them, right? So anyway.
Yeah, exactly. And also, if you think about it, this is on crypto assets, which themselves have a volatility level that's way above like traditional stocks or anything really. So yeah, it's definitely a good thing that's happening. But anyways, to go back to sort of how a perpetual works, like I said, there's 2 main differences. The first is that it doesn't have an expiry date. And then second of that is the trading of perpetual contracts is actually based on an underlying index price. And this index price essentially consists of the average price of the asset in the spot market. And the reason, and this is typically calculated as, like I said, sort of a weighted average of different spot market prices and their relative trading volumes. And so this is unlike conventional futures. Perps actually trade at a price that is very similar to their spot markets. There's not the same sort of pricing dynamics that you would see in futures in terms of contango and stuff like that.
Yeah, let's not go into that.
Yeah, let's stay away from that.
But you've now mentioned BitMex, FTX. These are centralized, exchanges or entities that you can do this kind of stuff. And the volumes in derivatives on these exchanges is massive. So again, it goes back to that question. If I can get tons of leverage and I know that I'm entering into a super duper liquid market, which is incredibly important as a trader, why would I ever use a DeFi derivatives protocol versus engaging directly with one of those centralized exchanges?
Yeah, it's a good question. I mean, and just to give an example, FTX, which is the main sort of centralized crypto platform, does $11 billion in trading volume every day.
In perps?
Yeah, just in perps. That doesn't even include their spot market.
Yeah.
And I mean, that's why you see FTX like partnering with Tom Brady and buying the rights to the Miami Heat arena, like they recently did, FTX arena now.
So basically, you're saying they're able to do that because they basically have a money printing machine there. Yeah, right.
Yeah, exactly.
So it sounds so well. That makes it a very interesting market to disrupt, right, from a DeFi perspective, because we're talking about probably the most profitable business in the whole crypto asset space. And I think anybody who knows from traditional financial markets, like at least on the sell side, the derivatives desks make way more money than the bond desk or the equity desk does, right? Because these markets are kind of inefficient, sometimes opaque. Margins and spreads are really wide, and perhaps that's similar in the crypto space as well. So it does seem like a juicy target for DeFi.
Yeah, for sure. And that's why, like I said, there's all these new platforms like dYdX, Perpetual Protocol, and Future Swap. But to kind of give a sense of the relative size, Perpetual Protocol is the largest, or to my knowledge, is the largest decentralized derivatives platform. And it does about $150 million a day in volume. So which is just around 1.5%, you know what I mean?
Of the size of FTX, yeah.
Yeah, and that's why I kind of say that derivatives haven't hit their sort of inflection point yet. The same that automated market makers and lending platforms like Aave have.
Well, I was gonna say, like, if we were having this conversation exactly 1 year ago, you'd say, well, Uniswap, it's really interesting and everything, but it's a tiny fraction of the size of, Coinbase or Binance. But in the last few months, there have been many days, where Uniswap has exceeded Coinbase's volume, and that's just because the growth curve has been so significant. So the question is, do you think derivatives are going to hit an inflection point, or is there something about that market that you think will always remain centralized?
Yeah, no, it's a really good question. I think derivatives will hit that inflection point, but again, I can understand why it's taking longer. One of the
why is it taking longer, do you think?
These systems are simply so complex that sort of, I guess, like the first level of the lowest hanging fruit for DeFi was truly just lending and then and AMMs. And derivatives, and what in our later episodes we'll talk about insurance, those are sort of higher up on the tree in terms of the level of complexity and also, I guess, the ease of getting a product out to the market. So that's really, to me, it's truly complexity. And the reason why that's so important is that complexity breeds risk in a decentralized system. So what I mean by that is the more complex your smart contracts, which are obviously sort of how all these DeFi platforms are built on, the higher the chance of a hacker exploiting your contracts, exploiting an error in the code or an error in the system logic. And so it's taking longer for people to get more, I guess, comfortable with decentralized derivative platforms relative to lending and automated market makers.
Well, do they have reasons to be worried? Have there been hacks of derivatives platforms? I mean, has that been an issue, or is it more just something they think could occur?
Yeah, so not to my knowledge, I don't think there's actually been too many big hacks of these derivative platforms. Again, because they haven't really hit the same scale as lending platforms and AMMs.
Yeah.
The big thing though is I think we actually sort of brushed up a little bit on it in the lending episode. The derivative platforms use a similar sort of liquidation system that lending uses. So what I mean by that is if I want to take a long position in a perpetual, I have to actually put up some collateral. And whenever I put collateral, these DeFi systems use sort of an intricate system of oracles or data feeds to tell the system whether someone's collateral needs to be liquidated to protect the overall derivative platform. And the thing with these derivative platforms is, unlike lending, which is kind of a slower moving market, so the data feeds don't need to be, I guess, as high performance. Derivatives is such a fast moving market. And what that means is that a lot of the DeFi platforms that use kind of smart contracts for the entire process are at a big disadvantage to centralized platforms, simply because blockchains are slow. So right. It creates this risk and creates a lot of risk for liquidity providers because these price feeds take too long to update because blockchains are slow. It puts you at risk of arbitrage. And what's happened, the reason why I think perps are going to kind of hit their major inflection points soon is that at this point, most people have sort of realized that mainnet derivative platforms, and what I mean by mainnet is Ethereum-based derivative platforms, are not really a real possibility because Ethereum, the mainnet Ethereum is kind of too slow and too clogged at this point.
Yeah.
So what these derivative platforms are increasingly doing is shifting to these layer 2 networks, which are typically trade off a little bit of security for higher performance and better speed. And that's sort of allowed these platforms to really take off. And to go back to my previous example, something like Perpetual Protocol, for example, actually exists on a separate side chain on Ethereum called XDAI, which is more centralized and therefore sort of less secure, but much better performance in terms of speed.
You know, it's interesting. We're talking about something pretty esoteric. I'm not going to lie, derivatives on DeFi, but there are still a lot of comparisons that can be drawn to other periods in history. The example of derivatives platforms that are decentralized not performing as well as centralized ones because of the time it takes for blockchains to work is analogous to almost every other technology revolution in human history, where initially the example of what the technology was kind of slow and not particularly useful. You know, people thought cars were a bad idea when they were created. You know, the internet was considered nothing more than a fad. And it's true that, you know, in the early days of the internet, you couldn't build Google Maps because there wasn't a, you know, satellite system, and you couldn't build Netflix because there wasn't high bandwidth, and you couldn't build Uber because there wasn't geolocation and smartphones. But, you know, eventually the technology catches up. If it's a good idea, the technology solution will be created. And, you know, a lot of people think derivatives are not a great idea. I mean, Warren Buffett calls them weapons of financial mass destruction, though he never shied away from trading them himself for his own book, a separate issue. But, you know, it seems to me like this is one of those things that's just an implementation challenge to be overcome. In other words, if there's an opportunity here to, you know, create value for traders and to offset risk, which we'll talk about next week, and DeFi is a solution to that, then that challenge will be overcome. So I agree with you. I think that this is one of those sort of longer down the curve use cases that hasn't had its inflection point, but it almost feels inevitable that it will. So I think it's a good thing that we covered it on the podcast, and I'm sure we'll be revisiting the subject for future episodes as well as the market grows and becomes more mature. Andrew, a pleasure as always to talk with you. That was another great episode of DeFi Decoded. Thanks everybody for joining us. You can catch DeFi Decoded on YouTube and wherever you get your podcasts. A reminder that DeFi Decoded is a partnership between 9 Point Digital Asset Group and Prophecy DeFi. And we'll see you next week. Thanks for joining us.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.